With that, I think we're going to wind up having a panel discussion, right?
Oh, I'm sorry, I thought you...
Okay.
Exactly. Covered. Yeah. And let me ask our other panelists to join us now, if they would, please. Mark Hemsley, CEO of Tabb Europe, Scott Liscoe, Senior Equity Trader at Pyramis, and Chris Clack, Professor Chris Clack, who chairs the Financial Stability Forum at UCL. And there we are. Hi, good to see you. And let me kick off. As a journalist for many, many years, more years than I care to remember, we have only one law of journalism, which says something like, first simplify, then exaggerate. And let me offer that as a thought to you and follow it up with the idea that this is more of a casino. I mean, having sat here for the morning, one gets the impression that we are looking at a casino. Yep, nothing new in that. There's always been a casino aspect to the industry that you guys are in. More of a casino than it's been. If you accept that, who is the house? Who is the dealer? Chris?
I was going to pass that one.
Well, you can, but I figured since you are the academic here, then maybe you can offer the detached view from the high ground.
From the high ground, I think the thing that worries me most is who's losing out here. And the thing that worries me most is the effect of instability in the markets on the real economy. So when my group looks at financial stability, what we're really interested in is instability and systemic risk and the knock-on effects. So the knock-on effect onto pensions, for instance.
Yeah, which is considerable.
Yes.
Or potentially considerable. Exactly. Mark?
I don't think it is a casino.
You don't think it's a casino?
No, it's a colloquial way of characterizing it. I think that as we just talked about here, there are definitely things wrong with weaknesses in market structure, the types of things that Larry just talked about. You know, I'm fully supportive of putting limit up, limit down structures into the markets in a consistent manner across electronic markets, and that's exactly the sort of things that we need to do. And I think that what May 6 showed us was that we need to improve market structure, especially a distributed electronic market structure. That's what we need to fix. The market centres have got a tremendous role to play in that by putting in structures, better surveillance, etc., to improve the market. But it's not a casino.
Scott, casino or not?
Not a casino.
Not a casino.
I'll agree with Mark in that respect, that trading itself hasn't changed much. In the last 20, 30, 40 years, trading itself is the same. The way we trade, the way we interact with the market, the way the market has evolved has certainly changed. And it's changed the way that we, as I'll be the buy-side representative, the way as we as buy-side traders need to interact with the market. I'd say that the main difference between the buy-side trader these days than before is we are more sophisticated.
Yeah, right.
Not that we weren't tremendously sophisticated earlier, but our decision process has become more complex. We have more tools in our toolbox, to use an expression, and the way we interact with the market, it's forced us to reevaluate the way we do that interaction. And quite honestly, in order to honor your fiduciary responsibility from a buy-side trading platform's perspective, we've needed to reevaluate the way the investment process is made through the firm, the way that we have an efficient, effective investment process to honor our fiduciary responsibility. So that hasn't changed, I don't think, at all.
I would agree with that.
You'd agree that it's not a casino?
It's not a casino. I think what's happened is that the risk transfer process has changed. It used to be, go back 10 years, Scott would call up a broker and say, buy me this position. And then the broker would take that position on their books and then trade out of it for a period of time, and they would interact with the different exchanges to get it, to get in and get out. Today, the broker traditionally they don't want to take that capital risk anymore. They don't want to take that position, and what they do is they give the traders, the buy-side traders, tools so that they can better interact with the market. And I think what needs to happen, especially since, and so what you've seen is that the block business has gone down mostly because it's not a broker trying to put up 1 million shares. It's gone on to be an algorithm that's putting up a series of 100-share pieces, and to more easily and to absorb that order flow. It's not the traditional broker just buying 100 shares at a time. It's a machine that says, okay, I'm going to buy 100 shares, sell 100 shares. So the overall risk actually is going less from the dealer book and the bank book actually back to you. And it's more important for Scott for you to manage your risk in trading because
Without a
the
doubt.
broker's not absorbing it anymore. And the HFTs, instead of taking a position for an hour, are taking positions for seconds.
I think that
You've also seen a lot of what you saw in Europe post-Reg NMS, in the US post-Reg NMS happened very, very quickly in Europe as well. I mean, when we were sort of starting trading in 2008, post sort of MiFID introduction, you know, a lot of what we could see was that there were a few market-making firms over here, a few stat arb firms over here. Many of the order routers were relatively unsophisticated, and suddenly what we were offering was a much, much faster trading environment. And it's really very noticeable that what you've seen over the last years, you've seen many factors. You've seen more US firms arrive who've got experience of electronic trading and some of the way the US system has worked and adapting that to the European system. You've seen much faster trading systems. I mean, the systems like sort of BATS and Chi-X brought into Europe were tenfold faster than some of the incumbent systems, and now they've had to catch up. You've seen sort of high-frequency techniques start to be introduced into broker-dealer algorithms, and that's part of it. You've seen broker-dealers actively use posting liquidity as part of their execution strategies. So the market is changing incredibly fast in terms of how it works from electronic trading. So as a European MTF with an American parent, we're continually looking at it across and saying, well, this will work here, this won't work here, this is where the Europe's different, this is where the US is different, and just trying to work out what's happening. But it's moving very, very fast.
So is that it then? Is it as simple as that, Chris, that technology hasn't really changed anything? I'm simplifying again. Hasn't, possibly exaggerating, hasn't really changed anything. It just speeded it all up.
Well, let's come back to the central conceit of this panel, which is that we have a casino. Well, the markets most emphatically are not a casino. One of the hallmarks of a casino is that you can apply the mathematics of random numbers, and you can get these beautiful bell curves, and we have shown, history has shown us now, that that is not the case in the financial markets, that these distributions have what are called fat tails. So it's not a perfect curve. So we know mathematically that the markets are not a casino.
Well, not in a technical sense.
Not in a technical sense. Well, you can't apply a lot of the mathematics of the casino, you can't apply it immediately to the markets. You might think that's
philosophy,
because
the underlying philosophy. Dare we move into the underlying philosophies and that a casino mentality?
Well, where I'm going with this is that you might say that, well, that's because there aren't enough things going on. And if we just had more trading, then we'd see this perfect bell curve coming out. And perhaps high-frequency trading gives us that kind of volume so that we can get back to this beautiful, pure mathematical structure. But no, it doesn't behave like that. And in fact, if you want to draw an analogy, rather than drawing an analogy with a casino, I'd prefer to, I'm tending to, more and more now, draw an analogy with a temperamental adolescent. If you're looking at what's happening in the markets appear to be emotionally labile.
I love the idea. Emotionally labile, you know.
I think two things have been mixed up there. The first thing is technology has changed the markets. It's absolutely...
Technology has changed.
Absolutely. Okay. People are still buying and selling and still taking long-term investment decisions, but the capability of the market centres has changed and improved, and certainly the facilities that are being used by people in market making or very short-term stat arb or medium-term stat arb, the modelling, the algorithms, they've absolutely changed the way in which people can execute. It changed the way that people sort of interact with the market. So it has changed it, it's speeded up, and there's different ways of trading that have been brought forward. And I think that to mix up the distribution of events with the way the market is trading is a mistake, because many of these events are they exogenous events themselves, and so what we're talking about is, are we seeing more exogenous events that affect the market, and are we seeing them more frequently than we expected, rather than how the market behaves? You know, if you look at a pure casino, you're saying like spin wheels and you'll get some sort of normal framework. That's not the world we're working in. So you've got two factors: the world we're working in, the frequency with which you see shocks, and the way in which the market operates. And then what Larry just talked about, on top of that, we've actually got structural failings where, because of our regulatory environment and the way we've implemented that, the way we handle some of those exogenous events has changed as well. So I think things have changed a lot.
All right, so yeah, go on.
I was going to say, with all the innovation, the challenge to the ordinary buy-side trader is to keep up with all this technology. Most buy-side trading firms, unfortunately, are under capital restraints. They don't have the same capital as a BATS has in order to invest in all the technology. We get all the technology thrown on our desk, and now it's the buy-side trader and his firm's job to evaluate that technology to make sure you're deploying it to the market correctly so that you don't have a flash crash incident, and you have the right risk controls in place so that you can actually understand what a smart order router is doing, what the ultimate execution venue is doing. I think more buy-side trading firms these days are looking at top technology and now are really starting to study where they're getting their ultimate executions. They're doing more total cost analysis in order to better understand what all the technology does, how you can interact with the market faster. Sometimes it's better to slow it down. And I think that's what some buy-side trading firms are trying to do. Well, you can slow it down in the sense, you know, I think there was Andy Silverman's presentation yesterday had a very interesting slide when he was showing, you know, 5,000, 10,000 shares on an offer. If you as a buy-side firm or anybody else wants to go take that offer, that you send out 3 or 4 different trades to 3 or 4 different venues, and the speed is different between the different venues, so one may get to one destination quicker and the others will disappear because of HFTs or whatever. Sometimes it's better, you know, let's look at that technology, let's slow it all down, let's make sure all 4 orders get to the venues at the same time. And you can work with your providers, and I would encourage anybody, work with your providers that are designing these algos in order to make sure that there is no latency between the time one order hits a venue than another. Yeah, technology allows that, so in a good way and in a bad way.
The other issue there that Scott kind of mentioned is you also have to know where your order is going and how it's being handled, because to a certain extent there are folks that will wind up sending their orders before they go to the market to different dark pools, and then there are different players in the dark pools that may be able to see that. And so while you think your order is actually going from me to BATS, it's actually going from me to a dark pool, and there are people in that dark pool who see it to BATS, and then in that, or not, I'm not just picking on BATS, it could be any venue.
You can send them to us, we don't mind.
But then all of a sudden, because, you know, in that, you know, microsecond gap, they see, oh, well, you know, that market order didn't really actually go directly to the market, and I'm going to change my book, and then all of a sudden the order's not there to hit.
But again, that's something that...
but you need to work with your providers.
I mean, you talked about the sort of total cost analysis. I mean, it's just so much more than that now, isn't it? It's not just a slippage calculation. It's what was the routing, where did it go, which sequence did you go, how long did it rest here? So I think the understanding, I mean, the sort of broker-dealers are getting you know, very sophisticated about how they do this, and I think that the buy-side guys are also expecting to see that now as part of their allocation.
If technology hasn't fundamentally changed the rules of the game, what about regulation?
Certainly regulation in Europe has fundamentally changed the game. I mean, the introduction of MiFID has really unleashed competition, and I think the same is true in the US with Reg NMS as well. I mean, so it did fundamentally change how things worked.
Yeah, if you look at just the world, you know, again, you know, 10 years ago, you know, so you know, talk with, you know, Randy and Dave Cummings and guys from BATS, you know 3 years into like the creation of BATS, I think their total technology expenditure was like under $20 million. You know, if you look at trying to build out a trading desk at a large firm, $20 million, that's nothing, you know. The ability to get into this market, creating a matching engine, or Island, there was Josh and you know, sitting in a server room. You go on, you know, Island's website, you should be a live picture of Josh sitting tinkering away, you know, in the back room of Island. The ability to create these matching engines and the ability to create the algorithmic infrastructures are, you know, it's so much less expensive to do it today than it used to, you know, you couldn't even get a seat on the floor, you know.
Well, I think that's true in terms of access. I think the thing is now is obviously as the competition between the algos
Right,
gets
now
tighter, you've got to be a lot more sophisticated in how you're working with the market.
Yeah.
Agreed.
Yeah, Chris.
Yeah, and I'd like to make the point that I believe technology has fundamentally changed things, and I believe two things have fundamentally changed. The first is speed, the speed at which things can go wrong. And as we saw in Larry's presentation just now,
Well, sure.
we see
Yeah.
how fast
Classic
things can go
10
wrong.
minutes, 2 billion shares.
Yeah, extraordinary.
it's amazing.
Breathtaking. Yeah.
The second thing is that what we have now as a globally connected, distributed system of computers, where computers are interacting with each other, this is a wonderful experiment. In other industries where you get distributed systems of computers talking to each other, there's a central designer of that system. And there's a central designer who will test the interaction between the different computers, between the different algorithms, and will test for the kind of effects that only happen in distributed systems. We don't have a central designer. We have a wonderful experiment where anyone can come along with any algorithm, more or less, and plug it into this global system and see what happens. And the kind of things that happen in distributed systems are deadlock. That's a kind of gridlock, like traffic gridlock, where things just grind to a halt. You can get live lock conditions. So that's the hot potato effect you were talking about, where you've got 27,000 contracts being traded in 14 seconds.
And only 200
Only 200 were actually
switch positions.
So that's a huge,
that is extraordinary, isn't it?
a huge amount of wasted effort. And why is that a problem? Well, it's a problem for two reasons. The first is that bad algo, the $4.1 billion worth of E-minis being sold, the algorithm based the number of contracts it was trying to sell on the volume of trading being done at the time.
It's a self-fulfilling.
So suddenly you get this amplifying feedback effect, which is something that you get in distributed systems.
Well,
So-
I think that's sort of true. You know, I think it's a very nice view of what distributed systems look like. Anybody who's ever tried to stick together trading systems or settlement systems or anything, there's been a plethora of standards and things that don't work. So I don't necessarily, I think it's a very possibly academic view of the way the world really works. I mean, it's not a world of perfect interfaces and perfect handoffs. There are some, but it's not necessarily like that. And I think that, again, you look at some basic trading points like that, you know, when you look into that, what is perceived to be the initiating contracts, one of the fundamental problems is that it didn't have a limit on it. And so if you're dumb enough to put in one of the biggest trades of the year with no limit on it, you know, I mean, I'm not saying that the rest of it, you know, the follow-on effects were wrong and we should have fixed that, but it was a pretty stupid trade in the first place.
As well as all the retail orders that are just plain blind limits, and you know, people have a limit order to sell at 10, it triggers at 10, and now the stock's at a penny, and they realize they're selling at a penny and not 10.
I mean, people talk about, you know, fat fingers trades, that was a wrong order type trade.
Right.
And so,
Let me just see if there are any questions out there while we're. This is fascinating material. But let me, gentlemen, right over there. And by the way, guys, have a look at the board behind, if you can see it. Those are questions that have come in by BlackBerry of those from people who are presumably too shy to put up their hands or something. But anyway, we have a question from over there. If you want to pick one of those out to deal with it, by all means do. And yes, sir, over there.
Yeah, Paul Amory from Index Universe. A question for Christopher. I was very interested in what you said about the modeling of returns in a casino being possible using bell curves, whereas in financial markets it's not possible. Why do you think it is that we still hear people talking about alpha and beta when those terms really refer to financial theories that might have, well, I mean, you could argue been discredited by what we've seen over the last couple of years?
Okay, I heard about
I didn't get all of it
two-thirds of
either.
that, but I heard an important bit about why are people still talking about alpha and beta.
Yes.
That was my central, why are people using alpha and beta when those classical financial theories should really have been discredited by the events of the last few years?
Yes, and why are people using mean variance techniques? And why, and a whole raft of things, of risk measures, are we still basing everything on? Yeah. Well, because we know how to do that, and we don't know how to do the other thing. Yeah. And one of the things that my group is working on is trying to figure out the other thing, which is how do you really calculate the risk?
If you look at, if you read Nassim Taleb's book, Black Swan, he basically breaks apart all these issues that, you know, the market's not, you know, bell curve basically, and that there are these fat tails. The problem is that he doesn't have a real good solution to, okay, yeah, so what do I do? You know, he basically says, you know, all our risk management techniques are bogus, and okay, so what am I going to go pull my risk management down and not do anything?
I think the most important conclusion of that is also it shows you what you shouldn't do, which is rely blindly on a bell curve. Well, and that's probably
that's the main takeaway. Don't
the
rely
fact that you need to go in and sort of have way out of the money puts or calls as hedges or things like that. That's what that's pointing to, and I think that's the most important conclusion. That if you think it's a neat statistical, modelled, everything talks to everything, you're wrong. You know, there's failure in there, which can be exogenous political events, they can be technical events, they can be regulatory events. All of those things and the unintended consequences of how those interact. I think that's the most important thing of that.
Yeah.
Right.
Okay, well, there are two, if I can just finish the answer to this. Just to give you an idea of the kind of things that are going on in research groups at the moment, two areas. One is looking at trying to use real data, and from the real data, then inferring real distributions rather than model-driven approaches, and then using those real distributions to drive your risk metrics. That's the first thing.
Take all the fun out of it.
And then the second thing is the use of computer simulation technology to try and simulate unintended consequences of regulation, for example.
Yeah, all right. I see no more hands going up. What I'd like to do now, you've had a quick look at those questions. This isn't fair on you, really, but bearing in mind those questions and what we've been discussing throughout the morning, if you were coming back here, or to Paris, or whatever the next conference is, in 10 years' time, what's the, 5 years if you prefer, maybe 5 years, given the pace of change, what's the thing that we would be sitting here talking about at the end of the conference and thinking, bloody hell, what an extraordinary thing to have happened, where the devil do we go from here? What's the big issue? There's flash crash in the last year or so, high-frequency trading, these are the things that are dominating discussion now. What's going to be the next big thing coming down the pike? Go on, Chris, you're the academic, as I say. You're the professor.
I suspect 10 years from now, one of the biggest things will be empowerment of the public. And the way
social networking.
And the way they are able to control their finances and their own micro, nano investments day by day. They'll have it won't be an iPhone anymore, but there'll be an app running on it, which will run their investments continuously through the day. So I believe 10 years from now, we could be in that kind of realm.
The death knell for financial advisors, then, as far as the public is concerned.
Who's going to write the apps?
Who's going to write the apps?
And who's going to advise on which one to buy?
Yeah, okay, right. What a nice thought. Yeah, Larry.
Oh, good question. Two things. One, I think we'll be discussing a lot of the same things, just at a different level, because I'm not sure that you can really take financial risk out of a financial market.
But it wouldn't be a market then, if you took
yeah,
financial risk.
well, we'd have apps running everything. And I think the second thing is actually that in some of the things, and this is a totally non sequitur, different issue, is you know, as we go through derivatives reform, what we're doing is we're saying, oh, you know, derivatives are bad, and we're going to put them all in exchanges and make them transparent and standardize them and turn them into an equities market. But as we do that, we wind up putting them in the hands of way more people and making them way more liquid. And if you look at, you know, credit default swaps and, you know, currencies.
There are two prizes that haven't been claimed. Nathan Morris won an iPod, and he hasn't claimed it, but if he's gone, I suppose anybody can have it, really. Eric Goldberg won a bottle of bubbly, and that hasn't been claimed either. Thank you all very much. I think those who left early for lunch or had to get away or whatever missed a great panel, and I'm grateful to you all for joining in the way you did with such verve and gusto, and for all the questions throughout the course of the morning, and thanks all for being here, and happy trading over the next year. Bye.